5 hidden dangers in your trading algo, and how to fix them. Introduction. The automation paradox. Algorithmic trading offers undeniable advantages: increased speed, improved efficiency, and the removal of emotional biases from decision-making. By leveraging technology, traders can execute complex strategies with a precision and discipline impossible to achieve manually. Yet, this reliance on technology introduces its own set of unique and often overlooked risks, a concept known as the paradox of automation. While many traders diligently focus on managing market risk, they can be blind to more insidious dangers lurking within the logic and structure of their own automated systems. This article uncovers 5 of these hidden dangers. Moving beyond basic backtesting and profit curves, we will explore the critical concepts that separate hobbyist algo traders from professionals. You will learn why your model is a bigger risk than the market, what your risk metrics aren't telling you, and how the smartest trade is sometimes no trade at all. 1. Your biggest risk isn't a bad trade. It's a flawed model in the world of algorithmic trading. The greatest threat isn't a single losing trade but the system that generates it. This is model risk. The potential for adverse consequences from decisions based on incorrect or misused model outputs. It's a quiet but pervasive danger that can undermine even the most sophisticated strategies. The primary sources of model risk are often hiding in plain sight. Flawed algorithm design. The core logic is built on faulty assumptions about how markets behave. Overfitting the model is too closely tailored to historical data and fails to generalize to new, live market conditions. Poor data quality. The algorithm is fed erroneous or low-quality data, leading to flawed decision-making. System failures. Technical glitches, software bugs, and infrastructure outages can cause the best models to fail catastrophically. These are not mere technicalities. They represent fundamental errors in translating a market hypothesis into a live, capital-risking system. Algorithmic trading relies heavily on advanced technology and robust architecture. Any malfunction, outage, or error can negatively impact the trading algorithms. To combat this, professionals adopt a crucial mindset shift from reliability engineering, proactive failure hunting. This moves beyond a reactive "why did we lose money?" analysis to a proactive "how could we lose money?" framework. Instead of just reacting to losses, robust systems are designed to identify potential failure modes before they happen. A powerful tool for this is failure mode and effects analysis, FMEA. FMEA is a systematic, bottom-up methodology used to identify and assess potential failures in every component of your trading system, from data infrastructure and algorithm logic to execution gateways. By systematically asking, "What could go wrong here?" and "What would be the effect?" you can identify and mitigate critical weaknesses before they ever cost you real capital. 2. The 1% catastrophe fallacy. What your VAR isn't telling you. Many traders rely on value at risk, VAR, to quantify their potential losses. VAR is a statistical measure that estimates the maximum expected loss at a given confidence level. For example, a 99% VAR of $10,000 means there is a 99% chance you won't lose more than $10,000 on any given day. It answers the question, what is the most I'm likely to lose? But VAR has a critical, and historically devastating, shortcoming. It is indifferent to anything beyond its own threshold, and does not account for losses that fall below the VAR level. VAR tells you where the cliff edge is, but CVaR tells you how deep the canyon is below. For a trader, ignoring the depth of the canyon is a catastrophic failure of risk management. As the Turner Review, which set out the UK regulatory response to the global banking crisis, put it, VAR models ended up not containing risk, but providing false assurance that other prima facie indicators of increasing risk could be safely ignored. This is where conditional value at risk, CVaR, also known as expected shortfall, becomes the superior metric. CVaR answers a much more important question. When that 1 in 100 bad day happens, what is my average loss? CVaR quantifies the expected loss in the tail of the distribution, providing a true measure of the risk you face during extreme events. Unlike VaR, CVaR is a coherent risk measure, meaning it properly accounts for the benefits of diversification, especially in financial markets where returns often follow fat-tailed distributions. By focusing on the severity of losses during worst-case scenarios, CVaR provides a far more realistic and prudent view of portfolio risk. 3. Optimal can be dangerous. Why the full Kelly criterion is a trap. The Kelly criterion is a famous mathematical formula used to determine the optimal percentage of a bankroll to allocate to a single trade to maximize long-term growth. Given a trade's winning probability, P, losing probability, Q, and net odds, B, the formula calculates the ideal fraction, F***, of your capital to risk. F** equals P times B, Q, B. In theory, this provides the perfect balance between aggressive growth and capital preservation. In practice, it's a trap for the unwary. The danger lies in its extreme sensitivity to its input parameters. This sensitivity is fatal in financial markets, where parameters like win probability, P, are non-stationary and return distributions have fat tails, making precise estimation from historical data a fraught exercise. A small misestimation of your edge can lead to massive overbetting and devastating drawdowns. Using the full Kelly bet size is considered far too aggressive by nearly all professional traders. The universally recommended solution is a fractional Kelly strategy. Instead of allocating the full percentage suggested by the formula, traders use only a fraction of it, typically between 25% and 50%. This conservative approach significantly reduces volatility and smooths returns, preserving capital during inevitable losing streaks. For example, an iron condor strategy with an 85% success rate and 0.2 odds has a full Kelly recommendation of a 10% allocation. A prudent trader using a fractional approach would instead allocate between 2.5% and 5%, protecting their portfolio from the potentially ruinous effects of an overly optimistic model. 4. Winning by waiting. The smartest trade is sometimes no trade. Most trading strategies are designed for a specific market environment, or regime. A trend-following strategy thrives in a trending market but can be quickly dismantled in a volatile, choppy one. The hidden danger here is applying a good strategy in the wrong market condition. The solution is to equip your algorithm with a risk management filter that can detect the current market regime and turn the system off when conditions are unfavorable. Hidden Markov Models, HMMs, are a powerful statistical tool for this purpose. An HMM can analyze market returns data to identify hidden, or latent, market states, such as a low volatility regime versus a high volatility regime. A case study on QuantStart provides a clear demonstration of this concept in action. 1. Training an HMM was trained on historical S&P 500 SPY data to identify two distinct states: a low volatility state, number 0, and a high volatility state, #1. 2. Filtering this trained model was then used as a risk filter for a simple moving average crossover strategy on out-of-sample data. 3. The rule: the algorithm was blocked from entering any new long trades whenever the HMM predicted the market was in the high volatility regime. The HM filter demonstrates a classic risk management trade-off. It achieved a modest increase in the Sharpe ratio, 0.37 to 0.48, in exchange for a massive reduction in tail risk, cutting the maximum drawdown by more than half, from approximately 56% to approximately 24%. For any professional, this is an exceptionally valuable trade. By strategically staying on the sidelines, the algorithm improved its risk-adjusted returns without changing a single line of its core trading logic. 5. Your backtest is overly optimistic. Here's how to get closer to the truth. While backtesting is a necessary first step, it is fundamentally flawed because it only shows how a strategy performed on one specific historical path. It tells you what did happen, not what could have happened. This can lead to a dangerous overconfidence in a strategy that was simply lucky. To get a more realistic assessment of risk, you must use stress testing. Monte Carlo simulations are a powerful method for this. Instead of following the historical sequence of trades, a Monte Carlo simulation creates thousands of alternative performance histories by reshuffling the order of your trades. This process reveals a much wider range of possible outcomes, including worst-case drawdowns that your single backtest never encountered. The results can be sobering. Research from Build Alpha, cited by Lux Algo, showed that a system with a 1663.90** drawdown in a standard backtest could potentially face drawdowns as high as *5195.17 when subjected to Monte Carlo analysis. This reveals how severely a simple backtest can underestimate true risk. The purpose of Monte Carlo simulation is to detect lucky backtests and misleading performance metrics before risking real capital. A standard backtest reveals a single, realized past. A Monte Carlo simulation reveals the distribution of possible pasts, giving a truer sense of the risk embedded in the strategy's DNA. Effective risk management is about preparing for the distribution, not the single path. A robust framework must also include stress tests against historical market crashes like the 2008 financial crisis and the 2010 flash crash, as well as simulated periods of low liquidity, to ensure an algorithm is prepared for the worst imaginable conditions, not just the average ones. Conclusion: from automation to true robustness, successful algorithmic trading is not just about finding a profitable signal. It is about building a truly robust system that proactively manages a wide spectrum of risks, from flaws in the model itself to the chaos of extreme market events. Integrating more advanced risk management concepts, like measuring tail risk with CVaR, ensuring prudent capital allocation with fractional Kelly, avoiding unfavorable conditions with HIM filters, and understanding the full range of outcomes with Monte Carlo stress testing, is what elevates a trading operation from an amateur pursuit to a professional endeavor. These tools transform a simple, automated strategy into a resilient, all-weather system. Your algorithm is executing trades perfectly, but have you tested what happens when it's perfectly executing a flawed idea in the middle of a crisis it has never seen before?